Okay, come. Okay, welcome back. Thanks for making your way down. So today, right, let me just give a bit of a briefing about what we're going to go through. Okay, so lesson plan for today. Pointers. Okay, 2nd March. Yesterday we went through basically application of demand supply question. So all you need to do is you just need to know a few things. Number one, of course, in Egypt, men wear tapes around their pants in olden times. Okay, that is the main content that you need to know. Number two, the application is always about discuss impacts of certain events on a market. Okay, so the impacts are looking at in terms of how it impact the price, how it impact the output, and how it impacts total revenue or total expenditure. So what I showed you yesterday was maybe you can think of the FIBO method. Okay, factors, elasticities, bigger shift, link with a diagram, explain the price adjustment process, overall evaluation. Okay, and then I also went through a bit about those stuff where when to make use of elasticity. Okay, concepts. Okay, usually in two areas. First area is in the area of explain impact on total revenue due to supply shifts. Then you got to invoke PES. Okay, then when you do PDPS, when you have sharp changes. Okay, sharp changes. So I will the next lesson on the 16th March, I'll definitely go through this again for practice some questions again. Okay, Ken? Now today the main thing I want to do is to go through content on chapter 4. Okay, this is the main thing that I'm going through with you today. So it's going to be very content based. So please try to focus. Okay, this chapter 4 is basically about government intervention. Okay, to help producer or consumer. Okay, they call it government intervention in the market. Okay, i.e. market. Now, so just to introduce, every time always remember, wherever we talk about government intervention, you must always start with the aim of government intervention. So you just remember what is the aim of a government. Okay, the aim is to one, generally for microecons, A is to achieve efficiency. Okay, so actually in chapter 5, after your SA1, we will talk about market failure, how the market fails to achieve efficiency. That's why the government wants to intervene. The second one is income equity. Okay, they want to achieve income equity. So the third one is you can think in terms of all your macro goals. Okay, which I will go through in macroeconomics. Okay, so for this chapter, for chapter 4, what is the government's aim? Okay, the aim is to is to help to achieve income inequity, especially, so that is usually to help to consumers, for affordability, i.e. affordability. Okay, 2 is to help to ensure employment and survival of firms. Okay, why they want a firm to survive is because they want to ensure employment. So that's why can you see the reason why they want to help producer is because they want to ensure survival. Why do I ensure survival? So that we can have employment. Okay, why do you want to help the consumer? Because you want the consumer to have affordability. Okay, so for this chapter, you just remember these two things. So this chapter, there are basically for this chapter there are basically 4 forms of government intervention you must know. 4 forms. So what are the 4 forms? A, tax, indirect tax. Indirect tax. B, producer subsidy. C, price ceiling or maximum price, and D, price floor or minimum price. Okay, so I'm trying to just introduce to you first, so that later when I go through proper, at least got a big idea. Okay. 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 Now, wherever we talk about government intervention, you must try to focus on three main areas whenever we do it. Okay. One, you should focus on, okay, what is the aim and how it works. Okay, usually what is the aim and how it works, we try to back it up with diagrams usually. Okay, after that we talk about the benefits of the government intervention. We usually link it to the aims. Okay, then the third one is the drawbacks or the limitation. So these are your NETCs, the extent of the effectiveness of the government intervention. Okay, so that's how we break up our lecture later or lesson later, where we, okay, every form of government intervention, I will introduce you the aim. Okay, I will show you how it works, what's the benefit, and then we will talk about what's the limitation. Coffee is the best. Okay, so basically, I will go through the four forms. Okay, maybe I go through two first, then we take a breather, get a break, we come back, we go through the other two, then after that I summarize it, and that's it. That's it. Okay, very important. Okay, very, very important. Is for demand supply, right? For demand supply questions, if you realize, for demand supply question topic, right, it is actually only about 30% content, right? It's just Egypt men wear tapes around their pants in olden times, right? But it's about 70% application. They will not test you content questions. You will never see things like what are the factors affecting demand. They will in fact ask you what are the factors that cause an increase in price. So it's application. Now, but for chapter 4, it's different. Okay. For chapter 4, it's the flip side. It's 70% content. In fact, I think it's 80% content. So you have to, this one, no two ways about it. Okay, you have to really those that just came later, make sure to mark your attendance. Okay, so those that for this chapter, you just focus with me. I will concise it. I'm not going to give you a lot of technical analysis or all this. Don't have to. Okay, we concise it. You focus. I give you the main thing. You get it already. Honestly, you go into the exam, it's as good as just regurgitating it onto the paper. Okay, it's just as good as regurgitating it on the paper. That's all. Okay, again. So there's no such thing as I don't know one. Okay, this one. Okay, because honestly, it's just about, to be honest, a large part of it is memorizing. Okay, large part of it is memorizing. Okay, again. Yeah. Okay, come, let's go. Ready? Okay, so not to worry if you never manage to print it. Okay, I also never manage to give to you. Just tell yourself, whatever I type on it, you can just write like 2.1, 2.2, then you can refer to your notes. Again, let's go. Okay, so definition of text. There are basically two kinds of text. Okay, there are two kinds of text. So just remember that. Okay, so I just write it here. Okay, so that there are two kinds of text. Okay, A, your direct text. Okay. Oh, okay, can. Okay. So the direct tax. What is direct tax? Direct tax is just taxes on income directly. They tax your income directly. Okay, can? So actually, if my encouragement is when you go to high level in the future or what, just take a module on tax accounting. I think it's good. One of the regrets I have is that I never do accounting before. The problem in Singapore is that, not say problem, in Singapore, you can do economics without doing accounting. But a lot of other countries, they usually mix together. Okay, can? So if you can, go and do a bit of tax accounting. Just one module. You don't have to go and know the technicalities. Okay, so there are a few kinds of direct tax. Okay, maybe I won't just say income. Okay, wealth also. Okay, so what's the difference between income and wealth? Can you like example? Okay, so let's say what are some like example of direct tax? Of course, we all know, right? Personal income tax. Okay, for Singapore, the top personal income tax rate you have to pay, marginal income tax, wanna guess? How many percent? 32%. Okay, 22%. That's the highest in Singapore. Okay, but most of us average, we only pay about 10% tax. Okay, 10% of our income. Okay, in most other developed countries, okay, it goes up to about 45%. Okay, almost close to 50%. Okay, most countries top income tax rate is about 30+%. Okay, can? For Singapore, we are one of the lowest in the world. Okay, one of the lowest in the world. However, what do we have that other countries don't have? We have CPF contribution. So actually, if you think about it, average we pay 10% tax, but we contribute CPF 20%. You add together, it's about 30%. So it's about the same. Okay, can? The difference is that other countries have pension. Ours is we rely on our CPF. Okay, what other things that you have for tax? Wealth tax. What are some of the wealth they have? What's the difference between income and wealth? Income is what you earn. Okay, wealth is what you have, what you own. So things like property. Okay, so you have property tax. Okay, in Singapore, the very good. One of the reasons why Singapore property prices is very high is really because when you sell your property, there is 0% tax. Okay, 0% tax. Okay, so this is what we call some things like capital gains tax. Okay, what are capital gains? Capital gains means the capital that you own, which is the investment like property, like shares. When you sell it in Singapore, whatever you gain, you don't pay any tax. So for example, if you earn 200k in Singapore, okay, if you earn 200k, a lot of us like, wow, earn 200k, is that a high salary? Very high, right? You divide by 12, that's close to 20k a month already. So you have to pay about 15% tax on that average. What's 15% of 200k? About 30k, right? 30k in tax. But if you sell your house, let's say you buy an apartment and you sell it, you earn 200k, how much tax do you pay? 0. So actually, right, would you want to own a house or would you want to have high income? Own a house. So actually, that's what I'm trying to say. A lot of times when we study to try to earn a high income. You realize that we never learn about how to make sure that our wealth goes up too. Okay, so that's my encouragement. After A-levels, your world is your oyster. Go and read up. Okay, schools will not teach you all this. Okay, they will not teach you all this. Okay, can? So capital gains tax. Now, of course, company, what tax do they pay? Corporate tax. Okay, corporate tax. Corporate tax is what is a corporate tax? Tax on companies' profits. Want to make a guess? In Singapore, corporate tax is higher than personal income tax, or personal income tax higher than corporate tax? What do you think? Personal income tax higher, right? You sure? So, in fact, all countries in the world, the personal income tax is always higher. Okay, for Singapore, the highest, okay, 70% tax. Okay, for company profits. But most of the time you don't pay much. Okay, until you earn a certain amount. Okay, so can you see it's a 5% difference? So imagine if you are a man like Jeff Bezos. okay, Amazon owner, right? Amazon owner, maybe he earns about $1 billion a year. Let's say $1 billion. If he pay himself $1 billion, let's say he's a Singaporean, he pay himself $1 billion versus not paying himself and just declare his $1 billion profit. Okay, he will save 5% tax. What's 5% of 1 billion? What's 5% of 1 billion? $50 million. Just by paying himself zero income, okay, and let his company earn $1 billion more, he will save $50 million in tax. Okay, so that's what he does. Okay, Ken? So what you do is, a lot of time you see all this, billionaire, all this, they don't pay themselves $1 billion cash. There's no such thing as $1 billion cash. They usually pay themselves. So like you see, the boss of this certain company, he earned $20 million last year. Most of the time, $20 million, right, $1 million is cash. The $90 million is in company shares. Okay, company stocks. Why? Because when they sell off their stocks, they pay very little tax. Okay, Ken? So these are all the things that you won't learn, but these are the things I feel that is very useful. Ken? So after A-levels, go back, go read about all this kind of stuff. Ken? Okay, but for A-level econs, what do you need to know? You just need to know what is direct tax and indirect tax. That's all. So don't be too caught up. Okay, that's why my encouragement. Don't be too caught up in like, I need to put in 50 hours. Okay. Yes. Okay, Cam. Hey. Okay, Cam.
Okay.
Thank you. Okay. So what is indirect tax? Taxes that indirectly. Okay. So for your there are basically a few things. The main thing is of course your GST. Okay, goods and services tax. Why is it indirectly? It's because it's only when you spend. It's only when you spend then you get taxed. Okay, Cam? What else? Then of course other things. Okay, they call it tax duties. This one you learn in market failure. So things like alcohol duties. Okay, cigarette duties. Okay, these are all so-called, so funny they call it duties. Okay, but they call it duties because it's a duty to ensure that this alcohol and cigarettes are not over-consumed, so they tax you. Okay, now whatever the case, the thing you must remember, just remember this. Direct tax affects demand. EGYPT, the Y, income. Whereas indirect tax affects cost of production and therefore supply curve. So right, you must please remember that. It's a bit counterintuitive. A lot of us will be thinking like, GST shouldn't it be on us because we pay? Yeah, we pay, but actually it's already been paid. It's already been paid. The producers already pay it. They just push the cost of the GST to you all. But honestly, when you study later about indirect tax, technically the producers don't have to push a whole cost to you. They don't have to push a whole cost to you. They can choose to not push the cost. That is why when you go to some shops, they always say GST absorbed. We absorb GST. So why they want to absorb GST? Because prices will be cheaper. You have to pay cheaper. Very important. For example, now I run a preschool. The rent that I pay is 11K a month. But the company that I rent from, he's a GST company. So I have to pay an extra 770 a month. So 11,770. Ken? So of course I can argue with him and say, you don't charge me GST. Ken, is doable, Or even your customer service, the customer service, how many percent is that? Why is it like that? 10%, right? You can actually refuse it. So let's say you go to the restaurant, you don't like the restaurant service, you can ask for a waive. It's not compulsory, you can waive it. You can say, I don't like your service. Please cut away the customer service tax. Ken? So yeah, it's doable, The thing about Singapore is that we do not know our consumers' rights. We do not know our consumers' rights. Ken, I was, so these are some of the things in real life. Very interesting, Next time when you grow up, what's the first thing you want to buy? Big thing, the biggest item. What do you want to buy? House, right? In Singapore, you realize something, you buy a house, right? Let's say this month you buy at 500K. Then next month, right, maybe the property developer felt that it's not selling well, they lower the price to 400K. What will you be unhappy? Very unhappy, right? But what do Singaporeans do? Usually Singaporeans will just say, it's my luck. Too bad I buy early. But if you go to some other countries, right, those people that buy at 500k, right, they will come together as one group. They go to the developer and say, you are cheating me on my money. Okay, you better make sure if you give 400k, you also must give us 400k. Okay, so they know their consumers' rights. Okay, over here, a bit hard. Okay, can? So always remember that. Okay, but I'm not saying you must go there and knock door. I'm not saying that. Okay, can? Can? So remember that. Just remember this. Direct tax affects demand. Indirect tax affects supply curve. Okay? Okay, so that's the thing. So over here, you can just go and read up. Okay, there's this thing called ad valorem tax. Okay? What is it? Just remember, okay? Specific tax is a per unit tax. Okay, let me write here. Specific tax is a per unit tax. So for example, $3 per packet of cigarettes. Okay? So it's a per unit tax. Every packet you buy, you add $3. Regardless how many packets you buy, it's always $3 per unit. So this leads to a parallel, okay, shift of your supply curve. Okay, just remember carefully. Parallel shift. Most of the time, you always draw parallel shifts. Okay? The other one is called ad valorem tax. Okay? This is a percentage tax. Okay, so example, okay, we put a 5% tax, okay, on each packet of cigarette. Okay, percentage tax. Okay, percentage tax. Okay, 5%. So this one will lead to a pivoted shift of your supply curve. Later I will show you. Okay, can? Can see? Is it too small? Okay? Okay, stay here. Okay, come. Okay, so just remember that. So now we basically learn about effects of an indirect tax. Now, indirect tax is not to help consumer or producer, okay? But we put it here because it affects the market. It's usually more for market failure. So I just write it here, okay? Usually, what's the purpose of indirect tax? Okay, number one, okay, it is of course to raise tax revenue. Okay, number two, okay, it is to correct, okay, market failure, which is in chapter 5. Okay, which is chapter 5. So for this chapter, you just need to know one thing, which is the incidence of tax. So I'm going to write here. For this chapter, okay, you only need to know, okay, how to, okay, answer, okay, who this question. Okay, who bears a bigger burden or who bears a bigger incidence of the tax. Okay, and we talk about indirect tax. Okay, so that's all you need to know. Okay, what's the purpose and all this? Okay, other limitations of tax, you go to you'll be in chapter 5. Okay, chapter 5. Okay, done. So I'm just going to explain this. Okay, so this I must draw already. Okay, so a lot of drawing today. Okay, a lot of drawing today. Okay, come. Okay, indirect tax. Okay, so now when there's indirect tax, let's say when there's an imposition of indirect tax, it leads to an increase in cost of production because it's the producers that pay the cost. Okay, and then what happens is that there will then be a decrease in profitability. Remember I told you every time when cost of production changes, you always need the profitability. Just put ceteris paribus. This leads to a decrease in supply at every given price. Okay? Now, so if it's a specific tax, okay, it will shift from S to S1. Okay, okay, why? For example, let's say on the 5th unit, okay, at first is $2. Can you see? Then let's say they slap a $1 tax. Okay, so $1 goes up. Now it's no longer $2. It's $2 plus $1, so $3. Understand? So it all goes up. Okay, so can you see? So let's say if here, so let's say this is 150, so it goes up 250. So this is what we're talking about, decrease in supply at every given price. Okay, so what happens is that there'll be a parallel shift. Okay, parallel shift up. Okay, up or leftward. Okay, Cam? So that's at every given price. That's why. But don't worry about the numbers. Okay, at the end of the day, just draw parallel shift. You don't have to plug in numbers. I'm just trying to show you only. Okay, then the other one is ad valorem tax. So let's say if it's ad valorem, okay, it will shift out. Okay, percentage tax is always percentage. Why does it pivot out? So pivot, that's all. Why does it pivot? Because the percentage of every price, the gap will become bigger. The absolute gap. Alright, for example, let's say it's a 10% tax. So $2, 10% tax. So $2, 10% will be $2.20. Right? Now let's say if it's let's say $3 lah. Okay, let's say $4. $4. Okay. $4 of 10% of $4 is $4.40, right? $4.40. So can you see the gap here is 40 cents. The gap here is 20 cents. So as price increase more, the gap, the tax, like the absolute tax that you pay should get bigger and bigger and bigger. Right? So, but of course you don't have to add in numbers. At the end of the day, you just draw. If they tell you specific tax, you draw parallel shift. If they tell you ad valorem tax, you just draw pivotal shift. That's it. Okay, Cam? So don't have to add numbers in. You just draw the curve. Okay, not add numbers in. Okay. Okay, Cam. Because that's not the main point. Now, okay, so the main thing you must know is that, okay, so over here, can you see? So I'll highlight first, okay? A specific text leads to a vertical shift, upward shift. Ad valorem text leads to a pivot shift. Okay, so let me print screen this, then we can copy. Yeah. Okay. Okay, now we go to the more main gist. Okay, the main gist is that we're going to learn about what is the incidence, who bear a bigger incidence, or who bear a bigger burden of the tax. So usually, firms don't bear the full burden, even though the cost is on them. Okay, usually they don't. Okay, they usually try to push it to the consumers. But can it push totally to consumers? By right, no. Even though in real life it's like that, we always push it totally to the consumers. Okay, in general, whether consumers or firms will pay a larger fraction of tax, okay, depends on the elasticity of demand and supply. Okay, so let me just write out. Okay, I'm going to write it here. Okay, I'm going to just put it here. It's easier. Okay, just copy. Okay, 2.3. Okay. See, 2.3 or 4.3? 2.3. Okay. 2.3, yeah? Incidence of tax. Incidence of tax. Okay. So, okay. Okay. It's very important to talk about the burdens of tax. Okay. Firms usually don't bear the full burden of the tax. Okay. They try to push the tax in terms of higher prices to consumers. Okay, they try to push the tax in terms of higher prices to the consumer. Okay, but how much they can push? Okay, how much they can push? Okay, the tax, okay, to the consumers depends on, okay, main thing. This is a rule of thumb. Okay, relative price elasticities of demand and supply. Okay, relative price elasticities of demand and supply. Okay. Okay, intuitively, if PED is very elastic, will consumers be very responsive to a price? Very, right? So generally, if PED is very elastic, because consumers will be very responsive to the price, the firms cannot push the tax too much. You realize that? Okay, so it's about relative, because at the end of the day, it's not just about PED being elastic, it's about PS being more elastic or less elastic than PED. Okay, so let me just explain a few stuff. Okay, Now, the burden of the tax, okay, the burden of the tax on consumer and firms, okay, would depend on the loss of consumer surplus, CS from now on, and producer surplus, PS. So this is actually in one of the last part of your chapter 2 demand supply notes. Okay, I didn't really go through that much, okay, but you just need to know that I'm going to write it here. Okay, what is it? Okay. Consumer surplus, what is it? Okay, it is basically the difference between what the consumer is willing and able to pay and what the price, okay, the difference between the price okay, the consumer is willing able to pay and the actual price. Okay, the difference and the actual price and the actual market price. Okay, so it is basically the area below the demand curve and above the market price. Okay, Ken? That's all you need to know. Later I'll draw and show you. Okay, it's the difference between the price the consumer is willing and able to pay and the actual price that he paid. So if he's willing to pay for $10 but he only paid $5, what's the consumer surplus? $5. Okay, if he's willing and able to pay $10 but the market only charges him $5, the consumer surplus is $5. Huh? Okay, next. What is the producer surplus? Same thing again, okay? It's the difference between the price producer is willing and able to sell at and the actual market price. So if he's willing to sell at $4 and able to sell at $4, the market price is $5. Producer surplus is 5 minus 4, $1. Okay? If he's willing and able to sell at $4, but the market price is $5, the producer surplus is 5 minus 4 equals to 1. Okay? So, illustration or diagram, it is the area above the supply curve and below the market price. Okay, the area above the supply curve and below the market price. Okay. Now, good news, they will never test you on definition. Okay, so you just need to know only. That's all. Okay. Now, but the diagram, you need to know how to identify. In a diagram, you know how to identify the consumer surplus and producer surplus. So you must know how to identify, which is not like rocket science. Okay, Ken? Okay. Okay. So how do they arrive at the equilibrium point? A is through the forces of demand and supply. Okay, when they meet together, price mechanism. Price will act as a signal, right, to eliminate shortage and surplus, reaching an equilibrium price, PE, and equilibrium output, QE, where quantity demand equals to quantity supply. Okay, so where is the consumer surplus? It is the area below the demand curve. What is the demand curve? The demand curve represents all the prices that a consumer is willing and able to buy. Okay, that's what, right? So for example, like if this is the first unit, is willing to pay $10. Okay, but the price is only $5. Okay, price only $5. Then the consumer surplus will be $5. Understand? Then if he's willing to pay for $8, let's say, but he only paid $5, consumer surplus again. Understand? So of course, we sum it up, okay, we integrate it, okay, and say that generally the area below demand curve and above equilibrium price is the consumer surplus. Okay, the consumer happiness. Okay, the extra happiness that he has. Okay, or she has. Okay, that's all. So this is what we call the consumer surplus. Now, on the flip side, okay, the producer surplus. For example, for the first unit, he's willing to sell at $2, but he sold at $5. So he's very happy by this extra amount. Right? I'm very happy by $2. He's willing to sell at $3, but he sold at $5, he earned $2. So same thing. So these are all the producer surplus. Sorry, not consumer surplus. Producer surplus. So to sum it up, the producer surplus is the area above the supply curve and below the market equivalent price. Okay? Okay, now, few things to note. Okay, generally, okay, number one, consumers seek to maximize consumer surplus. Producers seek to maximize producer surplus. Okay? Right now, because when you, of course, I want to maximize consumer surplus, right? As much as possible, I want to pay free. Even though I'm willing to pay $10, but you charge me zero price, I'll be very, very happy. Right? Okay, so those of you who study a bit of economics, then you will know that why public good is market failure. Because if I am willing to pay $10, but if you charge me a zero price, I won't tell you how much I want to pay. Okay, Ken? So that's another chapter in itself. Number two, okay, consumer surplus plus producer surplus equals to the market welfare. Okay, market welfare. In fact, consumers' welfare, when we say, oh, consumers' welfare is hurt, is the same as consumer surplus. So why is consumer, they say like, oh, why is consumers' welfare affected by the imposition of a tax? That's because there's a loss of consumer surplus. Okay? Why is there a loss of producers' welfare? Due to the imposition of a tax. Because of a loss of producer surplus. They mean the same thing. They're synonymous. Producers and consumers' welfare equals to consumer surplus and producer surplus respectively. Okay? So that's why when we say market welfare, is consumer surplus plus producer surplus. Okay? So that's all you know. Huh? Stay with me, huh? Okay, finishing. Okay, I'll give you a break after I hey. Okay, endure a bit more. I just go through incidents. Once I go through incidents of tax, it'll be easier already. Incidents of subsidy will be easier for you already. Okay? Okay? So I need to go through this consumer producer surplus so you understand. Okay, now. So why is this linked to the incidence of tax? Okay? The incidence of tax will depend on the relative consumer and producer surplus lost. Okay? The incidence of tax will depend on the relative consumer and producer surplus lost. Okay? So you need to know how to draw the diagram, okay, and showcase the loss, okay, the losses. Okay, so stay with me. This is the part that is a bit confusing. Okay, you just stay with me. Okay, that will be the main thing. Okay, and in fact, last time before the new syllabus where there's two essays, incidence of tax and subsidy not very important, very rarely tested, but they have taken out the essay already. So now 30 marks case study becomes 45 marks. There's nothing much you can there's nothing much that you can test for the microecons. So incidence of tax is going to be tested. Okay, it was tested in the last year's A levels. Okay, and a lot of the public school prelims they also tested. Okay, so as A1 you'll be tested also. Okay, so just need to draw only. Okay, in fact everything that I go through today will all be tested in the SA1. Okay, so you just need to know how to draw. That's all. Okay, okay, chapter 1 is out. It's just 2, 3, 4. 2 and 3, what's there? 2 and 3 is just Egypt mathematics all that past the olden times, right? Okay, so you just need to know this. Okay, okay, stay with me, huh? Okay. Once I go through incidence of tax, we take a mini break. It will be easier for you for incidence of subsidy. They are very easy already because it's just the exact opposite. Of indirect tax. Now, in the exam, they won't tell you whether it's indirect or direct tax. They just tell you that, oh, GST. Then you must identify that it is indirect tax. Okay? And when they ask you incidence of tax, it's always indirect tax. Okay? It's not direct tax. Okay? Direct tax for incidence. It's just purely consumers, purely workers. Okay? Come, stop, follow through me, okay? So I'll go through slowly, okay? So for simplicity, I draw lump sum tax, okay? Okay? So S plus tax. D. Okay, now where is the original equilibrium? Here, point A. So let's call it Q naught. Original price P naught. Okay. So because of a tax now, equilibrium price is now at P1 Q1. Okay. Okay. Now why price increase? Due to a tax? Technically yes, but actually can there be a tax but yet price no increase? Can. Can. I draw here for fun. S plus tax, right? But what if demand is flat? Can you see that? Price didn't increase. Only quantity change. Okay, demand can be flat now. Reality, no. Theory, we actually talk about it. Demand flat means what? PD is perfectly elastic or perfectly inelastic. When price change, quantity change straight away. Let's say I increase the price, demand becomes zero straight away. So perfectly elastic. Okay, can? So actually, if you think about it, if let's say government impose GST, there's a chance that actually price won't increase, or how? Make your demand more elastic, right? PANTS, right? So for example, let's say if MDIS decides to increase the price of drinks for coffee, what can y'all do? The whole school don't go and drink for 1 week. Then after 1 week, they will decide, oh, okay, we decide to lower back the price. Okay? Because you make your demand perfectly elastic. Okay? So, but of course, in reality, it's not like that. Okay? In reality, it's usually like this. So actually, why price increase in econs? Price increase, not really because, yes, tax increase, but the tax increase lead to a... The tax increase leads to a... What leads to increase in price? Hey, what? I'm not asking rocket science question. What's that word? No, what leads to increase in price in econs? Shortage. That's all. Just remember that only. Shortage leads to increase in price. Surplus leads to decrease in price. Okay, so you need to explain shortage. Okay, that's all. Okay, so that's the thing you must remember. Okay. Now, so but where is the amount of tax? A lot of students, they think that tax amount is P1, P0. It's not. It's the vertical shift, remember? So this is the tax amount. Remember? I show you at the first, can you see? It's the vertical shift. Okay? So always remember, it's the vertical amount that is the tax. Okay? The vertical amount that is the tax. Okay, stay with me, stay with me. I'm going to take a time to show you, but in the exam, you don't write until so thoroughly, okay? But for explanation sake, I will make it more thorough. So let's label all the areas. Area 1, 2, 3, 4, 5, 6, 7. Okay, can? Area 1, 2, 3, 4, 5, 6, 7. Okay, right? It's like those childhood game, right? Okay. Okay. Now, before tax, consumer surplus equals to what? Area what? 1 plus 2 plus 3 plus 4. Am I correct? Area below demand curve and above the equivalent price they paid. Correct? Area 1, 2, 3, 4. Right? Area below demand curve and above equivalent price. Okay? How about producer surplus? 5 plus 6 plus 7. Okay? 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 Now, after tax is the issue. So after tax, consumer surplus now is, what is it? So they pay what price? They pay this price now, right? So consumer surplus is only area 1 now. Right? Producer surplus is a bit hard to see. Okay? So this one, you listen to me, okay, is... Now, producer surplus, right, a lot of students thought, oh, is the area below the supply curve and above the price. A lot of students think that is 2, 3, 5, and 7. But it's not. Okay? A lot of students think that it's 2, 3, 5, and 7. 4 and 6 is gone because 4 and 6, they don't sell that anymore. Q0 to Q1, they don't sell that anymore. Is that? So a lot of students thought that it's 2, 3, 5, 7, but it's not. It's area 7 only. Why? Because the areas 2, 3, and 5 is given to the government. Tax revenue. Two plus 3 plus 5. Tax revenue is what? Tax amount times quantity sold. Right? So tax amount times quantity sold. So this rectangle is actually your this triangle is actually your this rectangle is actually your tax revenue. Okay?
Why is it not above the new supply curve?
Because you can see a new supply curve, but then it'll be very you're gonna go up and see. Okay? So yes, you can do that also. You can say that, yeah, you can see that. You can either say area 2 or area 7. It will say. Also can. You can see as area 2. But if it's pivoted shift, that will be different already. Okay? Can. Okay, you can say it's area 2, no problem. Or area 2. But the thing is, if you say it's area 2, then it will be like similar tax revenue also. Can also. You can say area 7 or area 2. Both will be the same. Both will be the same. She's saying this. Okay? Both will be the same. Can I? But preferably say area 7 because you want to talk about the burden of the subsidy, burden of the tax on the producer. Okay, Ken? Now, so stay with me now. Okay, stay with me now. So, what is incidence of tax? The incidence of tax is basically asking ourselves, in this area 2 plus 3 plus 5, who will bear the burden? The burden will be depending on the loss of consumer surplus and producer surplus. So, burden of tax on consumer. Two, 3, and 5, which one is consumer surplus? Loss. 2 and 3, right? 2 and 3, right? So, 2 plus 3. Okay? Burden on producer? 5. Yes. Okay? What is 4 and 6? That's a deadweight loss. Deadweight loss means welfare loss. Welfare is what? Consumer and producer surplus. So because of a tax, the market becomes worse off. Worse off by the area of 4 plus 6. That's why it's a deadweight loss, a welfare loss. Okay? Because of a tax, the market becomes worse off by the area of 4 and 6. So it's a welfare loss. So that's why it's called a deadweight loss. Okay? Okay, Ken? Okay, now, so actually, if you look at it, over here when I draw this curve, it seems like the areas 2 and 3 is bigger than area 5. That means that consumers bear a bigger burden. Am I correct? But the thing is, that's because if you look at it, it really depends on the slopes of demand and supply curve. Okay, so the relative burden will depend on the relative slopes of demand and supply curve. Okay, i.e. relative PED and P, i.e. PED versus PED and PS. Okay. Okay. So I'm going to draw 2 scenarios. And then showcase to you. Then we'll take a break. Okay, Cam? Now, let's say 2 scenarios. One, PED is more elastic than PS. Okay? First scenario, PED is more elastic than PS. Okay? So you just draw demand, be very elastic. Okay? Demand, elastic. Okay? Supply, being inelastic. Okay. Can you see now? Okay. Loss of consumers. Okay, sorry, not loss. Loss of consumer supply is wrong. Consumers' burden of tax, the yellow area, is less than producer's burden, which is the blue area. Okay. Okay, so actually you don't have to do the 1, 2, 3, 4, 5, 6, 7. I did that because I want to show to you. But when you answer in exams, you don't have to do the 1, 2, 3, 4, 5, 6, 7. If you want, you can just label 1, 2, 3, 4. Also can. Okay, you can label this as 1, 2, 3, 4. Okay, up to you. Just if you exam, you can label this as 1, 2, 3, 4. Okay, so consumer's burden is 1 plus 2, producer's burden is 3 plus 4. Okay? So you realize that consumers bear lower burden. On the flip side, you try yourself. Now you try yourself. Okay, you try yourself. PED less than PES. Then you can take reference to my. Can you try yourself? Okay. Okay, you can label this as C here. Okay, C. So tax revenue equals to P1 BC P3. Okay, so on the flip side here, if you look at it, consumer's burden now is bigger than producer's burden. Okay, consumer's burden is the yellow area, or area 1 plus 2. Okay. Producer's burden is the blue area, or just area 3. Okay, tax revenue is the same thing. P1, B, C, P2. And why are you going to put P3 there? Okay, you can just put it at P2 for the PDPS, the left diagram. Okay, Ken? So if you realize so you realize that actually the relative burdens really depends on the differences in slopes. Okay, the differences in slopes. Okay? Okay? So, why? So let me explain it in words. Okay? So, then you break already. Okay, Ken? Why is it like that? It's because, okay, if PED is more than PS, that means that consumers are relatively more responsive to changes in price, right, compared to producers. Thus, okay, then just right, an increase in price will lead to a more than proportionate decrease in quantity demand, right? Okay, compared to, okay, quantity supply. Thus, therefore, it is more difficult for firms to push the tax, okay, in terms of much higher prices to consumers. Okay, and vice versa. Okay, vice versa. Vice versa means what? If you say PD is less than PS, what do you say? If PD is less than PS, less responsive, so less than proportionate, so it is less difficult for firms to push. Okay, so consumers are bear a bigger burden. Huh? Okay, that's it. Once you finish copying, let's take a 15-minute break. Okay, go ahead and wash your face. Huh? 10 minutes video, I think 10 minutes can, right? Just wash your face, then come back, we go for subsidy, okay? Okay, go and wash us, go and walk around, okay? Yeah, so you can walk around. Okay?